In this video, I am going to talk to you on the topic the one-way street. When institutional investors engage only in one type of activity, which could be buying, then what happens to the broader market? This is exactly what is getting tested today in our markets, especially in the mid and small cap space. Institutional investors are continuously getting in money in their mid cap and small cap funds, provided the funds are performing even decently. So inflows are continuous. And they have a compulsion to invest. What happens to an investor strategy when he doesn't want to invest, but he has no choice but to invest? Because investors are giving him money to be invested and he doesn't exercise discretion or choice. It is the investor who ought to have exercised that discretion and choice. He chooses to invest and puts the money into the fund manager has to go the next morning and buy. A fund manager in such a situation is clearly going to struggle to find value in this market. So he just goes in and buys all the stocks that he already owns in the same proportion to the extent of the money he has received. Now I'm going to ask you a question. If he really felt like selling one of these shares based on valuation, would the fund manager actually sell those shares? The answer is a simple, blunt no. Because if he sells today, he'll probably need to buy something else again, even for that value, because flows are so strong. So when flows are so strong, fund managers desist from selling. So they move completely away from the sell side and only focus on what to buy. That's why I said the market looks like a one-way street. This is not new to any of us, nor is it odd. Flows can only create this kind of behavior in fund managers. They don't have a choice. Effectively, if you take the mid cap, money is pouring into 150 stocks, out of which a fund manager can make a choice out of his own discretion. Money is also pouring into an ETF which has these 150 stocks where the fund manager has no discretion. So on the one side, fund managers are buying all the stocks in the ETF, and on the other side, they are trying to buy whatever they can in the actively managed funds. This is why you are seeing this froth in the mid cap space. If you go and check the first quarter results of several mid cap companies, you will not feel that they are compelling buys. Maybe a few would look very attractive, but I would not say that they are compelling buys, not many at least. But the category is looking like a compelling buy to the retail investor. What does he do? He somehow wants to participate in the mid-cap boom. So the entire universe of 150 stocks is under tremendous buying pressure. Which fund manager will go against this trend and sell a stock based on valuation? Most people would avoid. Therefore, the buying pressure will be very high in stocks with less floating stock and less than desired liquidity in everyday trading. So this euphoria is pushing up valuations very, very fast. And the more illiquid a stock is, the faster its valuation is going to rise. That seems to be what fund managers are expecting and what they are also kind of orchestrating in their portfolios, because they don't sell anything. They keep buying stocks irrespective of individual valuation of stocks because flows are coming in. And everybody who knows that they would buy without a let up also wants to tag along, create a sidecar for them to participate in that rally. This is a very peculiar bull market because usually the investor would try to participate in overheated parts directly. But here in this instance, It's happening very aggressively through mutual funds and ETFs. So that is what makes this bull market different from past ones. What should an investor do? I think that he should take a closer look at valuations of companies that constitute these indices. If most of the companies are overvalued, you should probably remove your money from these indices and keep it in a liquid fund or gold. But this is not an advice anyone would be willing to listen to because it's so hot. Nobody wants to be left out. Everybody wants to participate in even the most minuscule rally in a stock. This has created a stronger urge to trade and a lesser urge to own stocks for a very long duration of time. So, investors who are traditional investors are now taking to trading, and investors who are new investors are taking more affinity towards trading. This is a very peculiar situation in the Indian market. The valuation of Nifty are at times lower than the valuation of the Nifty Midcap 150. Nobody would have expected this to happen even 5-6 months ago, because at that time it looked like the small and mid cap space was done and dusted and nothing could really reverse their fortunes. But all that changed, and now you are again seeing euphoria come in waves in these spaces. So people want to buy them when they see that others are also showing this similar keenness. This is not an easy time to invest. If you are wearing the fundamental hat, you cannot invest. But if you want to wear the momentum hat, you would probably invest. And if technical look good, you are probably going to use technical and momentum as part of your decision tree and use them to make your mind on what you need to buy today, probably for a quick trade. This is a market where you need to be ultra careful, loss averse, and capital protective. This is a market where you must not seek higher returns until valuation comes to a zone where your investment into that company at that time can only create higher returns. So it's a time to be a little lazy, laid back, and to look for new opportunities where the market is not keen, but stocks do have enormous potential. Thank you for watching this video.